Wall Street has always been about information. The analyst who could crunch numbers faster, spot patterns others missed, and make the shrewdest judgment often won. But something remarkable is happening right now, and most people have no idea. Artificial intelligence is systematically taking over the work that made Wall Street analysts valuable in the first place. The question isn't whether AI will replace these professionals anymore. The question is how quickly and quietly it will happen. This transformation is happening not in dramatic waves, but in subtle shifts across the world's most powerful financial institutions. Each bank is making its move independently, but they're all moving in the same direction toward a future where machines handle analysis and humans handle relationships. The quiet invasion has already begun. Every major investment bank has been moving in lockstep toward the same goal, deploying AI systems throughout their firms. Goldman Sachs rolled out an AI assistant called GSAI Assistant to over 10,000 employees in 2025, with plans to expand it across the entire organization. JP Morgan Chase gave more than 200,000 employees access to its own generative AI tools. Morgan Stanley deployed GPT-4-powered systems that can search through 100,000 research documents and generate analyses in seconds. These aren't experimental programs anymore. They're production systems handling real work. Bank of America developed internal AI platforms for its global markets team that search and summarize research reports within moments. These tools have achieved 98% adoption rates among advisor teams. The scale of this transformation is staggering. Banks report that 73% of work done by their employees has high potential to be automated by generative AI. Goldman Sachs isn't just using AI as a tool. The firm is completely re-platforming itself on an AI-native foundation. This means reconstructing workflows across investment banking, trading, asset management, and engineering from the ground up around artificial intelligence. The strategic thinking is clear. Whoever masters AI integration first gains a competitive advantage that could last for years. When you look at the actual work analysts do, the logic becomes crystal clear. Junior analysts spend weeks building pitch decks, updating spreadsheets, researching company valuations, and synthesizing financial data. An AI system can now do what took 3 days of work in 30 seconds. Morgan Stanley's research assistant can retrieve insights from 70,000 proprietary reports annually and generate summaries instantly. JP Morgan's AI tools have shown they can reduce information retrieval time by up to 75%. These numbers aren't marginal improvements. They're transformative efficiency gains that fundamentally change how many people you need to accomplish the same work. The performance numbers are staggering. Here's where the story gets uncomfortable. A research team at Stanford Graduate School of Business created an AI analyst that had access only to public information and stock fundamentals. They tested it against real mutual fund managers over 3 decades. The AI outperformed 93% of human fund managers by an astounding 600%. This wasn't using secret data or insider information. This was just better pattern recognition applied to information everyone could access. When researchers tested AI models directly against human analysts' stock predictions, the machines beat the humans in 54.5% of cases. Remember, this was AI working with the same public information humans had access to. Even when comparing AI to analysts who had been debiased, researchers attempted to remove their typical biases. AI still outperformed in most scenarios. A machine learning system called Project Annie predicted that Johnson & Johnson's stock would drop about 10% in late December. Wall Street analysts were bullish on the stock because of major acquisitions and partnerships the company announced. They got caught up in what seemed like positive news. The AI looked deeper, found hidden connections in massive datasets that human brains cannot process, and made them more accurate forecast. It outperformed some of the top analysts in financial media because it could see patterns buried in information mountains that were too big for humans to analyze manually. Different AI systems are now achieving similar results across the industry. One AI-powered trading model achieved 85% accuracy forecasting 334 stocks up to 21 days ahead. Another system delivered returns that would place it among the world's most successful hedge funds. Dan Elfin's AI-powered investment strategy generated 376% returns from 2017 through 2025, compared to only 166% for the S&P 500 in the same period. Stocks rated with the highest AI score significantly outperformed the market on average. These aren't theoretical projections. These are actual results from deployed systems managing real money. How the banks are actually using this: Goldman Sachs AI assistant helps its 12,000 1,000 developers write and translate code, proofread client emails, and organize internal documentation. This frees up hours of human time daily. The system is trained to absorb Goldman culture and improve over time. But here's the twist. Instead of laying off everyone immediately, banks are slowing hiring. They're squeezing productivity gains from AI until they absolutely must add more human workers. Morgan Stanley's AI tools saved financial advisors approximately 15 hours per week on administrative work. That's not a 15-hour reduction per month or per quarter. That's per week. Imagine multiplying that across an organization with thousands of advisors. Companies like Rogo are AI startups founded by former investment banking analysts. They built artificial intelligence specifically designed to automate the exact jobs these founders used to do. Rogo's platform handles company research, drafts pitch books, builds financial models, and prepares client meeting materials. The platform is trained on financial data and banking workflows, making it devastatingly effective at junior analyst work. The company has raised over $75 million in funding because investors believe the market for AI-powered analyst replacement is enormous. Jack Coco, CEO of AlphaSense and a former Morgan Stanley analyst, argues that AI will actually enhance analyst jobs rather than eliminate them. His perspective is that AI makes human analysts exponentially more productive. A task that would have taken a human analyst days or weeks now happens in minutes. The analyst becomes more valuable because they can deliver better work, faster, to more clients. Deloitte Research supports this vision, estimating the top investment banks could boost front office productivity by 27 to 35% using AI. This could generate an additional $5 million in revenue per front office employee by 2026. These projections assume that humans remain integral to the process. The uncomfortable truth, the uncomfortable part of this narrative, is that it assumes companies will continue hiring and paying humans to oversee machines. History suggests they often don't. When spreadsheets replaced accountants doing manual calculations, companies didn't hire the same number of people to verify spreadsheets. When automated teller machines came out in the 1970s, banks didn't add more human tellers to verify the machines. When email replaced physical mail systems, companies didn't maintain the same number of mailroom employees. Productivity gains historically lead to workforce reductions, not workforce preservation. Some data suggests this is already happening quietly. Junior analyst positions at major investment banks are no longer as abundant as they once were. Incoming classes are reportedly 30 to 40% smaller than they were 5 years ago. MBA job placement numbers at elite schools like Harvard, MIT, Stanford, and Northwestern have deteriorated significantly. In 2021, only 4% of Harvard MBA graduates had no job offer within 3 months of graduation. By 2024, that number climbed to 15%. MIT saw a similar trajectory, with their figure jumping from 1% to 14, 9% in the same period. Something shifted. These elite institutions are producing graduates who historically could walk into Wall Street jobs. That's no longer guaranteed. The jobs getting hit hardest seem to be the lowest level analytical roles. Positions that primarily involve data entry, spreadsheet management, and routine report generation are the first to face AI automation. Roles that require judgment, relationship building, and strategic thinking are changing but surviving. A seasoned analyst who can interpret nuanced market signals, understand client psychology, and generate novel investment ideas remains valuable. But a junior analyst simply running models and formatting presentations, that's increasingly redundant in an AI world. The evolution, not elimination. What the banks are really saying is the analyst job is evolving, not disappearing. Tomorrow's investment banker will spend less time on grunt work and more time on client relationships, deal origination, and strategic decision making. AI handles the information processing. Humans handle the interpretation and judgment. The investment banking analyst role survived algorithmic trading. It survived high-frequency trading. It will survive AI. But thousands of junior analyst positions probably won't. The lesson for anyone entering finance is clear. You need skills AI cannot easily replicate. What this means going forward, the landscape of Wall Street is shifting beneath our feet. The analyst of 2026 will look completely different from the analyst of 2020. She'll work with AI daily, treating it as a colleague that handles certain tasks brilliantly while requiring human oversight for others. She'll understand how to prompt AI systems, verify their outputs, And add the human insight that transforms data into actionable intelligence. The hiring slowdown at major banks isn't because AI failed to deliver productivity gains. It's the opposite. AI succeeded so completely at handling routine analysis that banks no longer need to hire as many junior analysts to power their operations. This is the quiet revolution playing out across Wall Street right now. The machines haven't taken over the strategy or the relationships or the judgment calls, but they've absolutely taken over the work, and that changes everything about who gets hired, what they do, and how much their starting salary will be. The banks are adapting. The question now is whether the next generation of analysts will